Hey guys, Bill Campbell here again. Today we're going to talk about portfolio management, and we're going to start with an overview. Let's get to it. Remember that in portfolio management, we are required as financial fiduciaries to evaluate investments based on how they fit into the portfolio as a whole. That is to say, we have to take a portfolio perspective. It used to be that we operated under what was called the prudent man rule. And under the prudent man rule, specific investments, options for example, were considered too risky, and we were not allowed to recommend them to our clients. Over time, as modern portfolio theory became better understood and became more the standard, we started to change from the prudent man rule to what's now known as the prudent investor rule. And the prudent investor rule says that we don't look at individual investments in isolation, but we look at them in the context of the entire portfolio. And it may very well be that an investment that is risky by itself actually reduces the risk of the portfolio. I'll give you a simple example. Suppose you have a client who has a large investment in a particular stock, and they're concerned that the value of that stock might decline. It would be prudent to purchase put options on that stock, even though put options by themselves would be considered a risky investment. In the context of that portfolio, they act as portfolio insurance, and they reduce the risk of the portfolio because the value of that stock investment then cannot decline below the strike price on those put options. So we're required to take this portfolio perspective. Down at the bottom, notice the diversification ratio. You have to be able to calculate this. This probably will show up on your exam, so make sure that you know the formula for the diversification ratio. You take the standard deviation of returns for the overall portfolio and divide that by the average standard deviation of returns for all of the constituent assets. If you have a well-diversified portfolio, this number should end up being less than 1. And in fact, if it's extremely well-diversified, it may be that the standard deviation of the portfolio returns is less than each of the individual standard deviations, so you may get a number here that is much less than 1. The lower the diversification ratio, the better diversified your portfolio is. Make sure you can do that calculation on the exam. We're now going to talk about a number of different kinds of institutional investors. We start with pension plans. Broadly, there are two kinds of pension plans. There are defined contribution plans and defined benefit plans. From an analytical point of view, defined contribution plans aren't all that interesting. In a defined contribution plan, the individual investor, this would be like the employee of a company, will make contributions to their account, like a 401k in the United States. The employer might match some of that, so they might match dollar for dollar, or they might match 50% of the employee's contributions. But beyond the employer making contributions to the plan, there really aren't any particular analytical problems that we would have with defined contribution plans. The individual, the employee, is the one who bears all the risk. They have to make the investment decisions. They're the ones who have to make sure that they end up with enough money in their account when they retire so that they can do so comfortably, so that they can live. The employer, once the employer has made their contribution, they're out of the picture. So there's not much in the way of analysis that goes on in defined contribution plans. Defined benefit plans, on the other hand, lots of scope for analysis. Tuck this in the back of your mind. You're going to see defined benefit plans show up at level 2 in spades. There are going to be a lot of questions about defined benefit plans at level 2. You'll learn a little bit about it now. It's going to be even more critical at level 2. In a defined benefit plan, the employer has the obligation for the future payment. They promise the employees that they will pay them a pension after they retire. It may be for a specified period of time. It may be for whatever their remaining life is. So the employer bears the risk. They're the ones who have to manage the assets, grow the assets, and ensure that there's enough money in the pension account so that they can pay the retirement for all of their employees. Typically has a long-term time horizon. The employees may work for this company for another 10, 20, 30 years. After they retire, they may live for another 10, 20, 30 years after retirement. So this is a very long time horizon. The risk tolerance in a defined benefit plan tends to be high because of that long time horizon. If you have 1 or 2 years of very poor investment returns, that's not such a big deal because you still have lots of years left to go where above average returns could make up that difference. So generally a high risk tolerance. The income needs is going to depend on the age of your beneficiaries. If you have a lot of young workers and not very many retirees, you probably don't need a lot of income generated in this defined benefit plan. On the other hand, if you have a much older workforce, if you have a lot of retirees, so you have payouts ongoing at the moment and you expect your payouts to increase, you may have increased income needs so that you can match those cash flows. Liquidity needs tend to be low because it's generally easy to project exactly what your cash flow needs are going to be. So you don't have to have a lot of liquidity to cover that cash flow. You can plan ahead and determine what securities you need to sell to match all of your cash flows. Endowments. An endowment is an organization that typically provides ongoing financial support for, let's say, a university, a museum, a hospital, something like this. Their time horizon tends to be long. They're going to supply financial support for this university for 20, 30, 40, 50 years, or they're going to support this hospital for the next 20, 30 years, or a museum for a long period of time. So once again, because they have a long time horizon, that typically gives them a high risk tolerance. They can afford some slightly riskier investments because if they have poor returns one year, those will be offset, we hope, by better returns in future years, and therefore they can tolerate a little bit more risk. Typically low income needs. They generally tend to invest in assets that are going to appreciate for the future, not assets that generate a lot of present day income. And typically low liquidity needs as well. They generally just need to be able to produce enough income to meet the ongoing cash flow needs, the day-to-day operations of whatever entity it is they're supporting. Unless they have liquidity needs, maybe they're planning to add a new wing to the hospital or renovate a museum or build a new football stadium at the university. Typically not a very high liquidity needs. Insurance companies. We usually segregate insurance companies into property and casualty and then life insurance companies because their needs are very different. Life insurance companies tend to have a long time horizon. Their policyholders are going to live potentially another 10, 15, 20, 30, 40 years, maybe longer than that. And so they don't have to plan to pay out on their policies for a long period of time. Property and casualty insurance companies, on the other hand, these are fire insurance, earthquake insurance, auto insurance, and so on. They typically have a much shorter time horizon because they're typically paying claims much more frequently. People get into car accidents a lot more often than they die. People have fires in their home or damage to their home from earthquakes or tornadoes or other natural disasters much more frequently than the people die. So they have a much shorter time horizon for property and casualty. Their risk tolerance tends to be very low. Typically you find that insurance companies tend to invest in fixed income securities where they try to match the cash flows of their securities to the anticipated cash flows for the payouts they have to make on their policies. So because they don't know exactly what the timing is going to be on the policy, they tend to have lower risk tolerance. If they have a large loss on their investment and that happens to come at a time when there's a natural disaster and they have big payouts, that could ruin the insurance company. So generally low risk tolerance. Income needs are typically low. They typically tend to invest more for capital appreciation. Again, they try to match their investments to their anticipated cash flows, but they don't really need the cash flow coming from their investments. They're getting cash flow from their policyholders. Remember that insurance companies receive premium payments periodically, every month or every 6 months or however often the policyholders pay. So that takes care of a lot of their cash flow needs. Their liquidity needs, on the other hand, can be very high, higher for property and casualty than for life insurance companies. They have to have highly liquid securities so that if they have to make a payout on a claim, that they can convert those to cash easily and make those payouts. Banks. Banks typically have two kinds of assets. They have loans. They get money, they get deposits from their depositors. They take that money and they lend it out. So those loans are assets on their books. But they can't lend out 100% of their money. Of course, you know that there are reserve requirements. So whatever the excess reserves are that they keep, those are assets as well. Now, the banks typically don't keep a lot of their reserves in cash. They invest those in securities that are going to earn them some income. The idea is that they would like to earn a spread over what they pay their depositors. So they want to invest in securities that earn them a higher rate of interest than the rate of interest that they pay their depositors. Banks' time horizon tends to be short because the time deposits that the bank gets can be withdrawn at any time. People write checks, they take money out of the ATM, and so on. So they tend to have a relatively short time horizon, and because of that, their risk tolerance is low. They cannot afford to lose money on their investments and then find that that happens at exactly the same time that a number of their depositors want their money back, and the bank doesn't have enough money to be able to cover the withdrawals that the depositors want to make. Income needs, because they have to pay interest on the deposits, they typically want income from their investments that is sufficient to cover the interest that they have to pay on their deposits. They don't generally need income beyond that, but they want to at least cover the interest they pay on the deposits. Liquidity needs, as I say, because the depositors could come in at any time and withdraw their money, banks typically have high liquidity needs. Some other types of investors. Mutual funds. We'll talk a lot about mutual funds in a little bit, but just a sort of a brief overview, mutual funds, specifically open-end mutual funds, tend to have high liquidity needs because they have to be able to redeem shares. If their shareholders want to sell their shares, they would sell it back to the open-end mutual fund, so the fund has to have cash available so that they can redeem those shares. That's about the only thing you can say in general about mutual funds. The time horizon, the risk tolerance, the income needs, that's all going to depend on the type of fund and the fund objective. And we'll talk a lot about funds in just a little bit. So be patient and we'll get to specifics on that in just a bit. Sovereign wealth funds. These are funds managed by individual governments. And depending on the nature of the fund, their investment goals may differ. They may have a fund that they're managing for pensions for government employees, or they may have a fund that they're managing that they want to grow so that they can fund infrastructure projects. So different investment goals lead to different characteristics for these funds. They typically invest for future generations. So they're going to invest for pensions that they're paying out in the future, or infrastructure. They're going to be building schools or roads or bridges, things in the future. So it's usually they have a future generation, a future goal that that is their objective. Frequently, they manage foreign exchange reserves. If you have a country that has trading partners that trade in currencies other than that country's domestic currency, then they have to be able to manage their foreign exchange. They have to be able to manage the foreign currencies that they're using with their trading partners for their imports and their exports. Finally, they might be managing government assets. As I said, pension funds would be a typical example, where the government owns the fund. It's a defined benefit pension, so they have to manage those assets so that they can pay out the pension to their government employees after their retirement. Now let's get into the portfolio management process. There are 3 steps to the portfolio management process. The first step is planning. You need to understand your client's needs and constraints and write those down in an investment policy statement. The format of an investment policy statement is that you have an objective section and you have a constraints section. Under the objectives, this is where you put the return requirement and you put the client's risk tolerance. So you need to understand how much money do they have to be able to earn, what rate do they would they be satisfied with 5% per year? Do they need 8% per year? How much risk tolerance do they have? Can they tolerate very risky investments, or do they require a much lower risk investment? So you need to interview your client and get all of these data, and that goes into the investment policy statement. There's also a constraints section where you would include things like their liquidity needs, or their taxes, or if they have particular restrictions on kinds of investments they can make, and so on. Any unique circumstances. Maybe they're planning to buy a house in a couple of years, so they need to have enough money available in a couple of years for the down payment on the house. Maybe in a few years they're going to be sending their children to college, that sort of thing. So all of this goes into the investment policy statement. Once the IPS is written, then you have to develop an investment strategy that is consistent with that. So an investment strategy that meets the minimum return requirement, that isn't more risky than their risk tolerance would allow, that doesn't invest in any securities that they have prohibited, and so on. Finally, you need to specify a benchmark against which your performance is going to be measured. You may pick a broad market equity index like an S&P 500, or if their portfolio is going to be, let's say, 70% equities and 30% fixed income, it may be more appropriate to pick a performance benchmark that is a combination of a broad market stock index and a bond index, so that your benchmark more closely matches the asset allocation in your portfolio. All right, after the planning, now comes the execution. We've decided broadly what kind of asset allocation we want, what kinds of investments we want. Now we have to go out and actually purchase those securities and put together a portfolio. We start by analyzing the risk and return characteristics of various asset classes. So we'll look at large cap stocks, mid cap stocks, small cap stocks, short-term fixed income, long-term fixed income, real estate, commodities, other alternative investments. We'll take a look at all of those and determine how those will fit into our portfolio. Once we know the risk and return characteristics of these asset classes, then we'll start looking at market conditions. So is the market more favorable toward equities at this point in time? Or are market conditions more conducive to investing in fixed income? So you can see that we're sort of taking a top-down approach. We're looking at asset classes broadly, we're looking at the economy broadly. Then we come down to picking the particular securities that we're going to put into our portfolio. So we've determined which asset classes we like. Within those asset classes, we're going to buy specific securities to put into our portfolio. We start with what we call a target or a strategic asset allocation. This would be, as an example, 70% equity, 20% fixed income, 10% alternative investments, maybe real estate or commodities, something like that. And then within that strategic asset allocation, we'll determine which specific equities we want, which specific bonds we want for our fixed income, which specific alternative investment might be real estate, might be commodities, and so on. Now this is our target, this is our strategic asset allocation, but occasionally as attractive investment opportunities arise, we may deviate short term from this strategic asset allocation. This we refer to as tactical asset allocation. That's short term, small deviations from the strategic allocation to take advantage of particular market conditions that make other investments attractive. Once we have our strategic asset allocation, then we start purchasing individual securities and determine how much of each individual security we want in the portfolio. A lot of this is going to depend on our assessment of risk. So we want to select securities so that we get a well-diversified portfolio, so that the correlations of returns on our securities is very low, so that will reduce the volatility of our portfolio returns. So we're always taking a risk management view as we're selecting individual investments to try to get, for the level of return that we want to get, to try to get the minimum risk, or for the level of risk that our client can tolerate, that we get the maximum return. The third step in the process is feedback. We have created the portfolio consistent with the IPS. Now we have to monitor our investors' needs and we have to monitor the market conditions. The IPS should be reviewed at least annually to see whether our investors' circumstances have changed, and possibly more often than annually if big events happen. Maybe the client just had a baby. That's going to change their circumstances, and that may be an appropriate time to review the IPS. Or they may have just purchased a house, or may have just changed jobs, or lost a job, or they're going to be sending their children to university, or their parents, one of their parents became sick, and all of a sudden now they have this extra burden of having to take care of their parents. So when big circumstances changes occur, then we should be reviewing the IPS and updating it, but no less often than annually. Every year we should get together with the client and review the IPS and see if there are any changes. We also need to keep abreast of what's going on in the market. We started off with market conditions maybe favoring equity investments, but over time the economy may change and now equity may be doing more poorly, but fixed income is doing better. So we have to monitor that and maybe update our asset allocation based on changing market conditions. We might also change our asset allocation simply because our portfolio has gotten out of balance. Maybe equities have done really well over the last year and fixed income hasn't done so well, so that our asset allocation now, because the equities have grown, has drifted away from our target. Maybe we wanted a 70% equity, 30% fixed income, but because equities have increased in value, maybe we're now at 80% equity and 20% fixed income. So we need to sell off a little bit of the equity, buy a little bit more fixed income to get back to our strategic asset allocation. Finally, we need to measure our performance. How much income have we earned? What kinds of returns? Has it been capital appreciation? Has it been cash flow from dividends or coupons or whatever? Measure that, report that. Report it to the client. Also report it firm-wide so that we can use this for performance presentations to potential new clients and so on. All right, now we're going to talk about a number of pooled investments. We'll start with open-end mutual funds. An open-end mutual fund does not have a fixed number of shares. As new investors come in with new money, the mutual fund will sell them new shares. They will take that cash and they will invest that cash in the securities that the mutual fund owns. When existing shareholders want to redeem their shares, when they want to sell their shares, they don't sell them to somebody else on the open market, they sell them back to the mutual fund. So the purchases, when people purchase shares from the fund or when they sell shares back to the fund, these are all done at the net asset value. This is the value of the assets per share. So take the total value of the assets owned by the mutual fund, divide by the number of shares, that's the net asset value per share. That's the price at which we have purchases or redemptions. Because the mutual fund has to be able to purchase back shares whenever a shareholder wants to sell, an open-end mutual fund typically has a cash reserve that's on hand to make those redemptions. What that means is that some of the cash they get from investors doesn't get invested in other securities. It has to be kept as cash or near cash so that it's available to redeem shares. That means that there's going to be a cash drag on the performance of the mutual fund. So bear that in mind. Open-end mutual funds, you have this cash drag about which you have to be concerned. There are also fees for ongoing management. The management, as they're determining what securities to buy, what securities to sell, as they're engaged in selling new shares and redeeming shares and so on, there are management fees that go with that. Some mutual funds have loads. They have upfront charges. So when you purchase shares, there's a fee just for purchasing them upfront. Or when you redeem shares at the end, there's a fee for redemption. Sometimes there's both. There are also funds that do not have loads. No upfront charges, no redemption charges. Obviously, investors prefer those. They aren't as common as most investors would like, unfortunately. But just know that there are some open-end mutual funds that have loads, front end, back end, others that don't. Closed-end mutual funds, unlike open-end mutual funds, closed-end mutual funds have a fixed number of shares. They're not constantly buying and selling shares with new investors or old investors. They issue the shares like an IPO, and now the shares trade on the open market. So if you want to buy shares in a closed-end mutual fund, you don't go to the fund and buy shares. You go to the market and you buy shares from an existing investor. They trade just like shares of stock. So there are commissions on the trade, there are bid-ask spreads on the trade. You can basically do everything with these that you do with the stock. You can buy them on margin, you can short sell them, and so on. Closed-end mutual funds do charge a fee for their ongoing management because their management has to determine in what assets they're going to buy, what assets they're going to sell, and so on. So you have to pay for that with a management fee. Depending on demand for the shares, if the market finds that this fund is very attractive, a lot of people want to buy it, then the price can go up and actually differ considerably from the net asset value. If the market decides that the style on this closed-end fund is somewhat out of favor, they don't particularly like it, then the price per share could go down below the net asset value. But because closed-end mutual funds don't have to buy and sell shares with investors, they don't need to hold excess cash. They are not going to experience the cash drag that an open-end mutual fund will experience. Every dollar that they get in, they can invest in investments. They don't have to keep it as cash. So they typically, you would expect that they would have higher returns because they're investing in securities that provide higher returns than cash. We can classify mutual funds by their investment objectives. For example, you might have a money market fund. These mutual funds would invest in short-term securities, maybe short-term treasury bills or commercial paper, very short-term, very liquid, very low-risk investments. You might have a bond fund, and within bond funds there are a million categorizations. Bond funds could be high yield, where they invest in less than investment grade corporate bonds and expect to earn their money through the high yield, the coupon, and possibly price appreciation on those bonds. They could be global, investing in bonds from a number of different countries, or they could be domestic. They're only investing in bonds from the country in which the mutual fund resides. And within domestic, it could be only government bonds, it could be only corporate bonds, it could be a mix of government and corporate bonds. They could have long-term investments, short-term investments, mid-term investments. Some mutual funds invest only in tax-exempt securities like municipal bonds and so on. So within bond funds, there's a great scope for diversity. If you have a client who wants to invest in fixed income, no matter what their specific goal is, there's almost certainly a large number of bond funds that have exactly that same goal that would provide useful investments. Mutual funds can also be stock funds. They could be actively managed funds where the manager is trying to look for good opportunities for appreciation, and when he sees attractive investments, then he will sell some of his existing securities and buy new securities. And of course, that active management, because he's constantly doing research and buying and selling, there are going to be fees associated with that active management. Or you may have a stock fund that is an index fund. It simply tries to track a particular index, the S&P 500 or the FTSE 100 or some other stock index. Obviously, less research is required, less trading on the part of the management, and therefore the management fees for an index fund should be lower than the fees for actively managed funds. Finally, we have balanced funds. These would be funds that invest in, let's say, some stocks and some bonds, or maybe other investments as well. Beyond these, you could have commodities funds, you could have real estate funds, you can have very specialized funds, you can have sector funds that only invest in financial stocks or only invest in healthcare stocks, and so on. So a great variety of investment objectives within mutual funds. Now let's turn to exchange-traded funds. These are much more closely related to the closed-end funds about which I was talking a little bit ago. Typically, well, at least originally, exchange-traded funds were mostly index funds. They mostly tracked particular market indices like the S&P 500 or the Russell 1000 or the DAX or the FTSE or some other market index. Lately, exchange-traded funds have gotten a little bit more exotic, and some of them, well, there are even ETFs these days that are highly leveraged and use derivatives to try to, let's say, instead of tracking the S&P 500 with returns that are similar, they may try to track it, but with returns that are twice as high as the S&P 500 or 3 times as high. Or maybe they try to track it, but in reverse. So when the S&P 500 goes up, the exchange-traded fund would go down, and vice versa. So there's a lot of variety in exchange-traded funds. The shares trade on the open market just like the shares of closed-end funds. So if you buy an ETF, if you buy shares in an ETF, you buy it from an existing investor. You buy it on an exchange. So you can treat it just like an investment in a stock. You can short sell it, you can buy it on margin, and so on. The dividends that are paid, dividends and coupons that are paid by the investments owned by the exchange-traded fund are typically paid out to the investor. That, in contrast to dividends and coupons in a mutual fund, which frequently are reinvested in the fund. They're reinvested in the securities that the fund holds. Dividends and coupons in an exchange-traded fund are paid out to the investors. Exchange-traded funds generally involve in-kind purchase and redemption. So if you want to create an exchange-traded fund, you usually have a pool of stocks and you contribute that to the fund and you get back shares. Because of this, the market price tends to be close to the net asset value. That is, it doesn't tend to deviate go much above the net asset value or much below. So in that sense, an exchange-traded fund is somewhat different from a closed-in mutual fund, where the share price on a closed-in mutual fund could differ considerably from NAV. On an ETF, it generally doesn't. And this last point here, there may be some tax advantages over open-end index funds, in particular because the exchange-traded fund doesn't have to redeem shares, whereas an open-end index fund does. If the index fund has to redeem shares, they may have to sell assets, incur capital gains that they would then have to pass on to the investors. An exchange-traded fund doesn't do that, and therefore may not have a taxable event. So it may have some tax advantages over investing in open-end funds. Separately managed accounts. These are owned by a single investor. So you have an investment management company that maybe manages several mutual funds that, of course, have a number of investors, but they may also have some separately managed accounts where these are owned by a single investor. Sometimes these are referred to as wrap accounts because you have a single investor, but then you have this management company on top of that who's managing the funds. So we refer to this as a wrap account. Generally, the minimum investment for a separately managed account is going to be on the order of $100,000 to $500,000, maybe even higher. So these are not accounts for small investors. These are generally accounts for large investors who want to have some control over their own investments, but want to have a management company who is helping them with that as well. Another example of a pooled investment is a buyout fund. This is typically where the fund will buy all the public shares of a publicly traded company and take the company private. In the news just a couple of days ago, I heard that the founder of Best Buy is trying to create a buyout fund. He wants to buy back all of the shares of Best Buy and take it private. He currently owns about 20% of the shares, wants to buy back all of the shares because he thinks that Best Buy has not gone in the direction that he would like, and he wants to get back control. He wants to restructure the company, maybe set it off on a little bit more profitable direction, and then sell the shares after he has it going much better. Typically, buyout funds use a lot of debt, high leverage. So they may borrow, most or all of the money that they're going to be using to buy the shares back from the other shareholders, restructure the company, fix the cash flow, resell it at a profit, maybe pay off the debt, maybe not pay off the debt until they sell it as an IPO. So this is what a buyout fund is. A couple of more funds. Venture capital funds. These are funds that typically provide startup and early stage financing for companies. Because they're financing companies that are startups, they expect that a large number of their investments are going to end up worthless. You know, of course, that most small companies that people start end up failing. Only a few of them really succeed. So the venture capitalists know this. Even though they do a lot of due diligence and they try to make sure that they're investing in companies that have good prospects, they know that a lot of them aren't going to do well. What they hope is that the one or two that do well do extremely well and more than make up for the losses on the large number of them that fail. Venture capital funds typically are active in the management of the firms in which they're investing. So they provide startup money for a small company, but knowing that many managers in small companies don't have a lot of management experience, the venture capital company will provide management assistance. They'll provide guidance. They may actually put their own managers in there to run the company. Finally, we have hedge funds. Hedge funds are not registered and they're not offered to the public. And hedge funds can have an incredible variety of investment styles. It's almost impossible to categorize hedge funds as a single group. They're so varied. They have a small number of investors, and these are what we call accredited investors. These are sophisticated investors. These are investors that have at least $1 million that they can invest, or very high net worth. Hedge funds frequently use derivatives, frequently use leverage. They will use long and short strategies. They will use all sorts of exotic investment strategies to try to make money. As I say, long, short, global macro, event-driven strategies. They may engage in arbitrage between securities issued by the same company, going long their bonds and short their stock. All sorts of exotic investment approaches trying to earn money. So hedge funds can be extremely varied, and they're not for the faint of heart.